Good afternoon, Your Excellencies, distinguished guests. Thank you for staying with us at the SARA Conference 2024. We proceed with our program, and I'm joined now by an esteemed panel of people that have the expertise, the people with the money. So let me try and frame this conversation for us once again. And I'm going to say that when it comes to quantifying and pricing Africa's infrastructure gap, it's no exaggeration to say that the numbers are quite staggering. The World Bank, for instance, tells us that the annual financing gap stands at around 402 billion dollars. Did I say rand? Stands at around $402 billion, and says closing this gap will be key to ensuring that the continent fast-tracks its structural transformation and catches up with high-performing developing countries from other regions in key areas such as education, energy, productivity, enhancing technology and innovation, and productive transport infrastructure. The African Development Bank, for its part, tells us that the continent invests only 4% of its GDP in infrastructure, compared to 14% in China, and that bridging the infrastructure gap could increase GDP growth by an estimated 2 percentage points per year. So basically the vision of an integrated continent, a growing continent, a continent that is able to respond to its population's developmental needs, and the policies and programs that have been put in place to realize such a continent can, unfortunately, at times, read a bit like a continental shopping list. We know what we want and what we need, but show me the money seems to be where we get stuck. Yes, as it's always true, the challenges are, there for everyone to see, but it's only half of the story. The other half, obviously, is always the solution. And I can say a bit before I start the conversation, I can say a bit about this because over the past 18 months or so, I've been working with Harris General Partners, and I've seen how Africans are able to bring African solutions to African problems. So these challenges are there, but that's not where the sentence ends. That's a comma. That's followed by the completion that says, so what? What are we doing about it? And this is why this esteemed panel is seated here to help us answer exactly those questions. I'm joined by Humphrey Nugo from Afrexim Bank. From the DBSA, we have Bongo Bacela. Next to Bongo is Mr. Dirk van den Berg from UK Trade. And on the extreme left, on the other end, is Ms. Nina Yose from the IDC. And right next to me is Ms. Portia Dube. Thank you. From the ECIC. Thank you. So I think let's just start. I'll just go down the line. And I'm under strict instructions to keep it lively and keep it moving. So unfortunately, did I not introduce you, sir? I'm sorry. Did I introduce you, Mr.? Okay, I did. I'm sorry about that. So I've been told to keep it lively and keep it moving. Unfortunately for you, you find us in the afternoon when we're now seeking to keep it moving. Just your sense then, Portia Dube, if I start with you and then go down the line, just your sense of what it is that we need to solve for before we turn to the issue of solutions. The story of rail infrastructure and perhaps the financing gap thereof falls within a bigger story of the infrastructure financing gap in general, with transport and rail in particular being subsectors, right? So your understanding of how big are the problems, how big is the challenge that we need to solve for?
Well, I think obviously I wouldn't want to dwell too much on the size of the challenge. The African continent is vast. the requirement for infrastructure development is undeniable. The concern that we have is not that there isn't a need for the development, but I think there are only a finite number of players that are able to bring the resources to develop. And the problem that we find on the continent is not that there are need for projects, but who develops the projects and where do the resources come through for the projects to be developed. It's not enough to rely on the sovereigns. As you can appreciate, infrastructure development for a sovereign, they have a lot on their plates. It will be from health, from their own domestic issues. But if we are to look at infrastructure, I think business can play a significant role in driving that development. And if I may plug in from the Export Credit Insurance Corporation, that is a lot of what we do. We crowd in the financiers to bring in the resources to fund the development that's required.
Yeah. Just next to you, Mr. Humphrey Nugo, just your overall sense, when you think about the challenge that we're trying to solve for, the infrastructure needs are obviously there, but how do we finance that? How do you frame it in your head and from your experience as well?
Well, thank you so much. I think, if you permit, it will help for me to start with introducing the African Export-Import Bank, just so that the audience understand who we are. So the African, can you hear me?
I'm battling to hear you, I must say. Let's see if...
Sounds a bit... Hello?
That's better.
That's better. So the African Export-Import Bank is a multilateral development finance institution that is owned essentially by African governments with a mandate to finance trade and trade-enabling infrastructure. And we are in this room today talking about railways and logistics. That is a trade-enabling infrastructure. And that is why we are here. We are here to let you know how we as a bank has been supporting the African continent in facilitating movement of goods, in facilitating trade amongst African countries. We know that African continental free trade is, in a sense, a silver bullet, that, as we all see it, of an action by African governments that will help leapfrog development. However, they are focusing on liberalization. So with liberalization of trade, etc., if it's not possible for goods to move from one country to the other, it is difficult for us to get the benefit of African continental free trade area. So that's where we sit. We have three key instruments of intervention. We provide funding, trade, finance, project finance, trade-enabling project finance. Headquartered in Egypt with regional offices, I work out of the Southern Africa Regional Office, which is based in Zimbabwe. And so essentially, that's who we are. Now, to your question of how we can bridge the infrastructure gap, I was listening to the panel, the one you call the board chairs panel.
Yes.
And the chairperson of Eswatini Rail was saying that they were profitable. The chairperson of the other one sitting, I can't remember which they said was, saying, no, it should actually be social, right? It shouldn't be talking about being profitable. And I was sitting there thinking, no, if we look at it that way, then it will be difficult for us to bridge the infrastructure gap on the continent. There is a limit to what government can do. They don't have fiscal space. All of them are talking about consolidation, etc., etc. They have numerous challenges. They will not be able to bridge that gap. Historically, 65% of infrastructure financing has come from public sector funds or funding through public sector. But we need to find a way of bringing in private sector financing into the infrastructure space. And the only way to do it is to commercialize that process. We cannot continue to be social. It has to be a business. We have to see it as a business. And that's why the Eswatini rail it's profitable. They say they're paying dividend. I don't
Yes,
see why
yes.
others cannot.
Yeah.
You follow? So there are very innovative ways that we have used to support rail logistics and infrastructure. One, for railways, I think most of the rail operators, because they are essentially government, we know what Green Road is doing and their partners, they price their products from a social perspective. So most of them are not being managed efficiently. They have a lot of inefficiencies, etc., etc. But if you bring in that efficiency that is required, we have financed quite a few rail operators through a very innovative scheme that we call offtake-backed finance. So that helps to obviate the weaknesses you find in the balance sheets of the rail companies by looking at the off-takers. So you have large corporates like Implant, etc., who need to take their goods to the market. We finance these rail operators on the basis of the balance sheet of these off-takers. So that way we're able to manage the challenges of the rail operators. So let me leave it there for now so I don't
All right,
dominate.
great. We will continue to unpack some of the themes that you have helpfully raised for us in your opening comments. And Bongo Pacela, earlier on we had DBSA on stage saying that you want to walk the talk. You almost want to, each time you return, give a status update that is different from the status update previously. How difficult is it to do that in terms of, given the task at hand? What's the task at hand that we are faced with from your perspective as the DBSA, as far as broader infrastructure is concerned, but freight and logistics and rail as a subset of infrastructure?
Good afternoon, everyone. Thank you to Lasiza for the question. I think maybe just to, in trying to answer the question, let me just lean on a few themes that came out of what Humphrey was saying. It's clear, I think everyone in the room will agree that there is a need to develop infrastructure on the continent, right? Why is that the case? Because we need to facilitate trade between the countries and also the continent and other continents as well. So it's a well-known fact, we all agree there's a need for governments and also financial institutions to play a role in developing of infrastructure in order to increase the trade and derive benefit from the minerals that we have as a continent. However, the challenge, as you alluded to in your opening remarks to Lasizwe, is that the funding it's like at 4% penetration. That's very low. And I don't think that's because of lack of liquidity. I think financial institutions at times are risk averse. There's an obsession to ask for government guarantees the further up you go on the continent, in order to say, where financial institutions are saying, yes, I see there's a project, but in order for me to be comfortable to finance this project, I need the government to back it, to stand behind it. For as long, in my view, for as long as we have that obsession, we're not going to do much we're not going to move the needle in terms of financing and developing the infrastructure. Therefore, we need to find creative ways to finance some of these projects. Humphrey just mentioned, for example, banking offtakes instead of saying we will bank balance sheets. So if you look at CNCC and DRC and any other railway company, most of them don't have huge balance sheets, right? So, but they would come to a DBSA and say, I have a 300 million rand balance sheet, for example. However, I need 2 billion rands to finance programs to improve my infrastructure and improve operations. In such a situation, it would be easy for a risk-averse bank to say, your balance sheet is too small to handle this debt. Yes, on the face of it, it is too small. However, if you roll it out over time and say, okay, I can put together a facility for you, but you're not going to do one drawdown. We do a phase-out drawdown. As the company, as revenues and the balance sheet improves, you then release the next tranche of funding so that they are able to grow to a point where the company has developed infrastructure and is able to afford the facility that you've provided. So I think in a way, what I'm trying to say to everybody that's here is that we as institutions, financial institutions, whether commercial banks or DFIs, we really also need to start thinking out the box and find creative ways to finance infrastructure and ensure that we develop infrastructure on the continent and move away from the obsession about guarantees from government. Thank you.
Sure. All right, I will come back to you because I think you raise interesting themes as well that perhaps have to do with the international financing models, how financing works internationally. But let me bring in Dirk Vandenberg from UK Trade into this. And Dirk, I don't know, perhaps you'll correct me if my framing is wrong. I would imagine that from your perspective, it's about moving from that mantra of trade and partnerships, not aid, is what the African continent has been all about, certainly from as early as the days of the cry for an African Renaissance, and that has never stopped, that it's about partnership and trade and not about aid.
Absolutely, and good afternoon to everyone. I think that's very important. I think trade, it goes with everything at the end of the day. I represent UK Export Finance, which we work very closely with the Department of Business and Trade from a UK perspective, where we bring in the supply chain itself. I think just from a rail point of view, I just want to say that I think that there's pockets of finance that might be going missing at this point of time. We know that there's a massive funding gap. We know that there's a lot of project that's on the table that needs to come to the market. I think from a lender's point of view and a funder's point of view, you always look at repayment at the end of the day. I think no funder and no lender wants to lose money at the end of the day when it comes to funding projects. From an ECA point of view, we've got very long repayment periods that hasn't been explored yet. I always say that from a UK point of view, we've got, just by way of example, £5 billion worth of appetite for South Africa. Now, I represent Southern Africa, and there's different levels of appetite in those Southern African countries itself. But it's something that's been very poorly taken up, if I can put it like that, from an ECA point of view. And I think it's a matter of people not necessarily understanding the ECA funding. Also, there's a lot of liquidity in the market to a large extent from commercial banks, and there's no commercial banks necessarily here. But we want, as UKEF, want to work with the DFIs, with the multilaterals and things. And I think there's a missing link there. And we've all committed to working together and looking at those projects that's there. Because, to get a 15 and a 22-year type of repayment period based on UK risk, because that's really what happens. They take a risk on UK government, which is AA rated, which is better than the sovereigns in Southern Africa. And therefore, it should be a more beneficial and more economic rate, so to speak. So that is obviously coupled with trade. I think the same time as the corridors have been mentioned, and the corridors are very, very necessary. I think funding across regional geographic spread, different countries, etc., it's complex, it's not easy. There's different jurisdictions, there's different currencies, there's different terms, etc., that needs to be taken into account. But again, I do believe that, if we sit together and we structure it right from the outset, that we can come to a better solution. And that's also where the High Commissioner committed as UK, is to, for us from a UK export finance point of view, is to have the workshops with the commercial banks, with the DFIs, and obviously the operators, to say, how technically can we fund it a whole lot better? And, again, the invitations to everyone on the panel here is to be part of those workshops and things.
Yeah.
I think we need to work smarter together, and then we can unlock some value.
Yeah. Nina Yose from the IDC, just how important is the role of DFIs in this whole conversation, particularly those that have, their grounding and foundations and roots firmly on the African continent?
Okay, it's on.
Oh, this mics.
I think it's on. Yeah, it's on. I think DFIs play a very important role. I'll speak for the IDC in this instance. IDC, we have what we call project development funding, and that is risk funding. That comes right at the beginning of a project in terms of bringing the project to bankability. So as IDC, we'll partner with the various sponsors that are putting the projects together, and then we'll bring it to bankability. And if you ask most lenders, I suppose, they'll tell you that there's a shortage of bankable projects. Yes, we know that we need a rail from point one to point B, but then who's the sponsor? Who's going to then put the risk money in there to bring it to bankability? Because once it's bankable, then the commercial banks are really available to put in the money. I'll also just touch on what IDC does in terms of the whole value chain, right? So as IDC, really, we look at the entire value chain, not just infrastructure. So we will look at manufacturing, whether it's manufacturing of locos, what's the sleepers, signals, everything that goes into the infrastructure on the rail. There's also mining. So where we then support mining, we will then look at the rail infrastructure to then evacuate those minerals, either then so mining as well as beneficiation of that. I think I've heard some African countries recently that they really want to beneficiate their own ore in their own countries. So then they export semi-finished goods as opposed to finish just the raw material. And then there's also agricultural commodities. So in terms of DFIs, yes, we play a very important role because we do take the risk where commercial banks don't want to take risk. Thanks.
Yeah. Let me bring it back to you, Bongo. Earlier on, you were talking, as you were talking, I got a sense that there's a conversation to be had about the project financing system as a whole, beyond, looking at it from the African continent perspective. You were talking about looking at the balance sheet as opposed to looking at other factors at play. And I think I've heard this conversation before, where there's even talk about the pricing of risk associated with, lending on the African continent, whereas it is said that the defaults rate are actually lower than other regions, but that's not what the world sees, is it?
Certainly, that's not what the world sees, right? So I think maybe just to correct one thing, I was saying there's an obsession with looking at balance sheet. That's what commercial banks do, and us sometimes as DFIs, to be honest. We do tend to make that mistake. In my view, it's a mistake. What I'm saying is, the argument I'm trying to put forward here is that if we think outside the box and look at, let's say, a client that is able to secure more volumes in terms of can move more cargo,
Yeah.
and they have a solid contract from a blue chip company.
The off-takers.
Yes, an off-taker. Why don't you bank that off-take and ring fence the funding for that off-take? So those are some of the things we need to think about as lending institutions and say, yes, you might have a small balance sheet or a very highly leveraged balance sheet, but because you have this good customer that is able to give you volumes that you need in order to afford the debt, that's what we need to chase.
Portia, I suspect you are itching to weigh in on this.
Well,
Just a suspicion.
I think my contribution to that, obviously, yes, if you have a strong enough balance sheet, you would do the balance sheet lend. DBSA, IDC, they do a lot of the project finance structures. But I think what's important to highlight is it doesn't matter how commercially viable a project is. We cannot run away from the political environment in which one operates. So you could have a very strong business case, but because of the political climate in which you operate, you will not be able to succeed. And even as the financial institutions, as they price the risk, they will not price it just based on the commercial viability. The political environment plays a significant role. And I think that's where we work quite closely with the IDC and the DBSA, as well as the commercial banks, because that's the risk that we cover. When your clients, you have let's say if it's an attraction and they are selling locomotives to another party in another jurisdiction, they are obviously concerned once they supply about their ability to be repaid. And as an export credit agency, together with Dirk, that's what we are there to try and bridge the gap and provide balance, because we will provide cover for the political risks that for political risk events. So it could be things like your currency inconvertibility, unavailability, war, civil disturbances. It could be things like terrorism. So the activities or the actions by the sovereign that would hamper or hinder trade. And we take it a step further, and if we are covering that project, we also cover the commercial aspects, which could be protracted default, either by the commercial entity or the sovereign, as well as insolvency. It's interesting to me that yes, we need to think outside the box. However, we cannot separate sovereign from commercial.
Right.
Because the policies that the governments create, or the environment that the governments create, will make or break for a business to thrive and to survive. So the two have to go hand in hand. It cannot just be commercial, Humphrey. I disagree. I think political, and even when we price the risk,
Yes.
you find that a significant portion of what you're actually pricing is the political risk.
Yeah. So what's the message then, if I stick with you for a moment? What's the message? And I suppose the message is quite obvious, but I'd like you to spell it out. What's the message for countries such as the ones represented in this room, in as far as the importance of policy certainty, issues of governance, stability, rule of law, and the likes?
Well, I suppose they cannot take their actions in isolation. We cannot have, on the one end, talk about investments if we don't create an environment that is attractive for investments to come through. And before we get there, we cannot wait for the continent to stabilize. And yes, I like that point about it's really about perception, because actually the continent is a great place to do business. But we are in business because there is this perception that doing business in the rest of Africa is actually riskier. But if you look at the stats in the Bern Union, from the statistics, from the defaults, they're much more significant in the OECD countries and other parts of the world. If you also look, for instance, at not just the rate of defaults, but if you're looking at the smaller countries, I think everyone will be hesitant because they think, oh, I can't do business into Zimbabwe because I won't get paid, and then they'll look at the debt to GDP. But if you actually look at the entities that have the highest debt to GDP, it would be your Japans. It's actually the places where we perceive to be more stable. And it's a mindset shift. I think everyone needs to think like an entrepreneur. If we decide that we're going to go in, you need to dive in and then make use of the resources that are there. You make use of a DBSA and their project preparation funding to assist to develop the financing. Make use of ECIC to cover those political and commercial risks that you perceive to be in that jurisdiction.
Sure.
To get the deals going.
One of the words I kept hearing from each one of you in your opening remarks has to do with concessions, as well as now talking about the off-takers, and that also talks to the importance of that model. Humphrey Nugo, if you can weigh in on that, the importance of, firstly, let me ask, are we at a point where it's settled now, this debate, whether or not the sovereign can fund the infrastructure we need from, its own resources, or have we come to a point where we realize that actually the sovereign can never, no matter how committed they are, no matter how well-meaning they can never cover all of this infrastructure that we're talking about? Has that debate been settled?
No, I'm not sure it's a debate.
Yeah.
I think it's a fact. With all good intentions, it's impossible for the sovereign to finance infrastructure requirements on the continent. It's just absolutely not possible for them to do that. Now, now if you separate the, let's say, rail into passenger and freight, the suggestion to use off-take back structures will be more applicable to freight when you're carrying cargo, goods, etc. On the passenger side, maybe less so. But what I was advocating is not to have a line between sovereign and private, but to say we shouldn't look at it as purely a sovereign affair, but think in a manner that we are able to attract private sector players. And the only way we can do that is to find a way to commercialize it, i.e. make the project to be self-liquidating. So we don't look at it as a social project, but look at them as commercial projects. Again, I was on that panel, I was listening to the Zambian board chair, Zambian Railway Corporation, I believe, and he was saying that they've been looking for funding for a very long time. And what you find is what they call the infrastructure paradox. The paradox is that there is a lot of capital, but yet a lot of projects looking for funding. How come they don't meet? What's the problem? So, because, I mean, as between ourselves, DBSA, IDC, and some other DFIs, my friend Davis was talking about the group of 5. Cumulative balance sheet in excess of $200 billion. We can finance all infrastructure requirements on the continent. But the truth is, we do not find the bankable projects. That is the problem.
Yeah.
Now, because those who need the funding are also coming from the perspective of sovereign, they are looking for guarantees and all that. They are not able to structure it. So through our project preparation facility, we're able to make projects bankable. We said to them, you can price it this way, you can structure it that way, and all that and all that. And then we come and provide the financing and we help you to raise equity. So I always argue against the fact that there's not enough capital to finance the requirements. I argue that we do not have enough projects, bankable projects, to attract the financing. There's a lot of funding, but as we know, they say capital is shy. So it goes only where it feels safe and where it can come back. So if it doesn't feel safe with the Zambian Railway Corporation, it will not come there. If it feels safer with the Zimbabwean structure, it will go there. That's the way it is. So my encouragement is to those operators, find a way to structure your requirements in a manner that you're able to attract private sector capital in demand. Then the public sector one becomes an add-on. I hope that's not, I was able to convince you.
Dirk, let me bring you in here. And I don't suppose I'm asking you, Dirk, a question you've not been asked here. When I ask about, to what extent do you find that hang-ups from an era gone by in terms of understandings of geopolitics, coupled with, I don't know, also perhaps hang-ups of a mistrust of some of the partners of the continent. Europe being one of them, I would imagine that you get asked about the UK, that, you know, okay, you want to partner with us, but what's in it for you as the United Kingdom? Is this really merely about neutralizing the influence of China and Russia on the African continent? I don't imagine that you've not been asked that question.
Yeah, no, sure. I think it's a very good question. And, you know, I think I would just start by saying there's so many competing projects out there. You know, and rail is so important for the economy because it actually stimulates the economy at the end of the day. But at the same time, too, there's social requirements that the sovereigns need to look at. You know, so where and how do they fund it? That's an important one. I think when it comes to, you know, UK funding and from a UK point of view, I would say, and I'll put it out there, is we've been massively successful in West Africa. We've been increasingly successful in East Africa, less so in Southern Africa. And the reason for Southern Africa, with the exception, I would say, with Angola at this point of time, and also Zambia to a certain extent, that we've been very successful in funding those countries from an infrastructure point of view for various projects, is that there's a lot of liquidity in the market for the banks. I haven't really seen any negative connotation, if I can put it like that, because of UK's offer. I think we really are far more competitive potentially. I think concessional debt and concessional lending is obviously, it should be used before maybe ECA debt, which is commercial, but attractive commercial. I would, however, say that concessional debt could come with a lot of conditionality, and one's got to be very mindful of that. Not to repay certain debts in scarce minerals or whatever the reserves are on that side. Whereas from a UK point of view, it's a commercial transaction rather than anything else. Repay it back and things. So to answer the question, I think from a Chinese point of view, China point of view, we've seen a lot of activity over the last number of years. I would say that there's less so to a certain extent from a funding point of view, and also the requirements are maybe a lot more. From a UK point of view, we only require 20% UK content, where other ECAs and other countries, mentioned by yourself, would want more, a 40 or 50 and 60% type of content type of thing.
Yeah.
So I would argue that there is a competitive argument for UKEF
Right.
and UK.
Ladies and gentlemen in the room, esteemed delegates, at this point, if we could have a mic, being moved around in the room, we welcome your contributions, your questions to the panelists. Perhaps we'll give it maybe another 10 minutes or so, so get your questions and contributions ready while I ask this one question, and then from there we will be going to questions in the room. Nina, it's one thing for us to be talking broadly about infrastructure, and it's a fascinating conversation, but specifically, what makes, and I don't know, perhaps it's an unfair question to throw at your doorstep, but what would make a rail infrastructure project bankable in the context of everything we've said about the off-takers and how you structure it? From your experience, what makes a rail project bankable?
Okay, so I think then it's about a summary of what everyone has said so far. So really, I think it starts with a bankable, I suppose it starts with a project. It starts with a project, it starts with cash flows. Are there cash flows? So where the cash flows coming from? And I think Africa is rich, like I said, with minerals. So you've got mines, we've got agriculture. So that's the starting point for any project, right? And then next, then you build in terms of layers. Then you need your technical partners. So the question is, who's coming as a technical partner, whether it's an operator, whether someone who's providing your, the locals that are coming in. And then, that's a technical part, the marketing, and then the financials, right? So basically, once you put everything together, the cash flows, your technical partners, the equity that's coming in from various sources, and really the issue of government, maybe you might not get grants as Bongo says it, but government might then be a equity partner and provide some sort of concessions, whether it's land or whether it's regulation. And then all the partners come in with equity. You then put everything together in what we call a financial model. And I guess at this point, as Bob's your uncle, you've got a bankable project. So really, the starting point is about cash flows. Yeah. Once you have cash flows, you can ask anyone here, you can structure a bankable transaction. You can bring in the partners. There's no shortage of technical partners out there. There's no shortage of skills. You can in-source the skills that you need. Yeah, so let's start with the cash flows. I'll leave it there. Thanks.
Yeah. I don't know if we have any questions or inputs from the room, from the delegates in the room. Yes, could we please have a mic coming to the front, and then in the third row? Let me borrow one. I think it's on.
Thank you, Chair. Thank you to the panelists. My question is not directed to a particular panelist, but any of them can maybe respond. But first, my name is Stevenson Ngubane from Eswatini Railways. I just want to know, most railways in the region or even in Africa are 100% owned by governments. That structure, the shareholder structure as it is, has been all these years, how is it enabling private sector participation or investors that would want to come and see an opportunity in the railways? I just want them to comment if they see how it is.
Thank you, sir. That's I think
So maybe
it's better that you go for it immediately while I move the microphone.
Right. So I think one other structure that I didn't mention maybe because of time was the SPV structure, special purpose vehicle. For you to attract private sector investment, you need to, as much as possible, delink yourself from political influence, from government interference, etc., and allow the business to run commercially. Now, the SPV structure is such that that National Railways Corporation, whichever one it is, sets up a special purpose vehicle that could be owned by them, that would then access the capital, would have debt equity within it to procure the equipment, procure rolling stock, whatever, and then lease out or use for the benefit of those who need them, the off-takers again. So everything, the cash flow remains there. It can pay dividends to the National Railway Corporation. It can pay fees for right-of-way, whatever. But the entity that would then be the one to procure the debt would be the special purpose vehicle. And we've used this in different markets. It has worked. So it depends on what the law of your country says, but that is an option that you may need to think about.
I don't know if anyone else would want to also add anything there? No? Okay. We can.
Can
yes,
I?
yes.
I think the SPV structure is useful because when you bring a private partner in, they may be able to attract more resources. I do believe, however, that it is important to still maintain that state-owned enterprise, and that is. I think the problem that we have is across the continent, we've got a lot of examples of state-owned entities that are struggling. However, there are quite a lot of examples, even in South Africa initially, were doing quite well. They've had ups and downs. So you can go back to that structure. And in Europe, you also have like, state-owned entities that come through and that brings, technical support. I think for strategic importance, it is important to maintain that state-owned ownership. And I don't necessarily believe that it's always negative. I think Nina brought up the point that a lot of what the rail does is that we've got a lot of commodities that move. So for food security, for the minerals that the government relies on to earn revenue, I believe that you still do need to have a strong weighting with state-owned entities. Bring in technical partners if they are lacking and if there's a requirement. I think we're not a lender as the ECIC, but we work with the lenders, and we are the lender of last resort, because if the project fails, we are the ones that then have to step in and fund repay the lender. But that's the sort of thing that we will look at. We want government to have skin in the game. We want the private entities to come in for the support and the technical expertise and the bringing in and crowding in the finance and new ideas and new technology. I'm a strong believer in having the combination of both. I think as the ECIC, we are there because we're a state-owned entity. It's a government initiative to bring in finance, to facilitate exports, to facilitate trade. It's a government initiative with IDC and the DBSA to include the manufacturing and to raise the manufacturing capability of the country and to have contribution in the project preparation. And I dare say the same for Afrexim Bank. It's a combination of sovereigns that are driving this trade and the initiative.
Yeah. All right, let's take a question from the gentleman there. Yes, sir.
Yes, thank you. I am Juvenal Abrão from Angola. I've heard you talk for the last 10, 20 minutes, and I think we are talking about bankability, but it's also important to talk about data, because bankability in the end is all about the data. And we have a lot of economic operators that are informal. They don't have the information available to the banks, because we must not forget that most of what the rail do is to transport goods. So we need to understand how the data work and how those information will enable the banks to be interested in this process. So if we don't share the data, if we not take all the data issue in continent, we cannot make the rail infrastructure process that is bankable. So I would like you to talk about the scarcity on data, the information that should be available to the banks, to the investors, so so they can be able to make the visibility studies on those rail lines. Thank you.
I battled a little bit to hear you for some reason, and it's not you, it's the something in the acoustics. But if I heard you correctly, you are talking about the importance of quality data and information to be able to inform investors about some of these projects. Who wants to tackle that? Portia, I think it naturally falls with you, but it's fine. I'll let you have the hook if you want.
So what kind of data are we talking about? Because especially
Agriculture. Especially the volumes, because we have a lot of producers, they use the lines, right? We talk about data volumes, because when we talk about bankability, we, in the end, want to know how much we're going to transport.
Yes.
So what about the data of those operators, agricultural, mineral, those operators?
Yes.
Most of the data is hidden in plain sight. We don't collect in a proper way. We don't share this data, right? So how data influence the process of bankability? I want to hear your thoughts on that.
It's integral. Absolutely, it's integral. And I think when every lender, and even as the ECIC, when we are assessing whether or not we will support a transaction, that is what we will look at. And we always, and so that comes now when you have a project, the project sponsors will usually bring that information. That's the market studies that we will look at. And we don't just take their word for it. We have an independent entity that also does an independent study for us to assess the viability and the bankability of a project. And I do agree with you that, having said that, I think we do operate in regional silos. If you look in the SADC region, the data is there. I think ECOWAS will have similar data, and they know in the continent what is being moved from where. There are people that have studies about what minerals lie where, what rail. I think we saw a little bit of that from domestically for South Africa, but the statistics are there. I think even African Union and so on, they have that information, and they even assign where we should source even the locomotives, etc. But the studies are there. Perhaps it's not, I don't know how we can share more on the continent, but the information and the statistics are there.
Yeah.
And you're absolutely right. It underpins whether or not we will look at a transaction.
Yeah. So I guess it's that value of setting in place systems such as the data rooms, etc., that you are able to set up in the development of a project. I'm not sure if we still have any further questions or inputs from the floor. Yes, I think we do have one on the left over there.
Good afternoon, everyone. I am Palma from Transnet. My question for the speakers today is to just get a bit of an understanding, right? The speaker from EICE mentioned that in order for, mentioned that when there's funding required, right? And when there's, no, let me just start here. So it was mentioned that we need to look at funding as well as the environment in which the customer operates hand in hand. However, it was well known that there is a high risk of quite some political instability within the region. So how do we bridge the gap, right, in terms of ensuring that those countries that are in need of finance for their infrastructure and rolling stock developments, how do they get that source of funding, though they are in those high-risk entities? One of the speakers mentioned that we need to look at the blue chip companies, the off-take agreements. However, you mentioned that sometimes that isn't sufficient. So I just want to get an understanding. How do we then bridge that gap so that we ensure that there is sufficient funding provided to those that are in need? Because we cannot leave them in limbo, as it's been mentioned that it's quite important to fund infrastructure development within the African continent.
Yes, so as the ECIC, we are the South African Export Credit Agency, and as I said, we provide political and commercial risk insurance. So what happens is when you have a bank that looks at a project in another jurisdiction, they will assess the transaction on a standalone basis and come to ECIC, and we wrap that transaction, we cover that project. And what that means is that when they are now pricing the risk, they will price it as South African government risk. So there are a few benefits where they may have constraints in terms of lines for that jurisdiction or appetite because of the political situation in that country. They will substitute that with SA government risk, so it almost becomes like a domestic loan. And that is effectively how we are assisting by, assisting the cross-border transaction by wrapping that project risk with that of SA government, and Dirk does the same with UK government if they're looking at a project. And to your point, I mean, we don't look at South African projects. Our mandate is only to look at cross-border projects. And why is that important? Because that regional stability, it doesn't matter how great the rail infrastructure is in South Africa, as you try and move the goods from South Africa to the rest of the continent. If you do not have a working system through Zimbabwe, Zambia, etc., your goods will get stuck. So we are facilitating trade, and by coming in to hold hands in other jurisdictions or with other regions, we then develop the region as a whole.
All right. Yeah, Nina, please go ahead.
Okay, thanks. I'd like to add to that. I think each project, in terms of risks, right, it's different. It's different strokes for different projects, different regions. And as bankers, what we want to do is we want to just see that that risk has been reduced sufficiently that we can make the investment. Where the risk is not sufficiently reduced, that's when the ECIC comes in and covers us for that risk. And there's a number of risk mitigation mechanisms out there, depending on what the risk is. I know, for example, there's externalization of revenues. If you're thinking that you can't get your money out of a country, there's a number of mechanisms, and there's a number of, like I said, ECIC, ECAs. Those then reduce the risks for us to an acceptable level such that we can then make the investment. Thanks.
All right. Dirk, I think you wanted to also chip in.
I was actually going to say exactly the same thing there. I think at the end of the day, you still want to make sure that you get repayment, right? But that is where you look at the offtake agreements, you look at the borrow, you look at everything else, and maybe where there's a shortfall, that's where the sovereign can then guarantee the shortfall thereof. So it doesn't come on as a contingent for the full amount. but it comes on for the remaining balance itself. So again, as Nina said, each and every application is different, but those are a couple of ideas that we can look at as well.
Right. The two gentlemen who seated in the middle get to have a final say. Maybe Humphrey, you can start us off. Earlier on, I was quipped that it's all about show me the money. So perhaps to wrap it up, given the challenge we're trying to solve for of infrastructure in general, freight and rail infrastructure in particular, but also weighing that up against the benefits of investing in that infrastructure, especially in the age of us talking about, sustainable development. Are you able to show us the money?
Yes, if you show me a bankable project. Well, I think I can weave what he said, and together with that. The first is, the starting point is, again, the word bankability, to have a project that works. You may have heard that 90% of projects die between conception or conceptualization and funding. Only 10% make it to funding. And why is that? Part of the reasons is because of lack of data. And that's why we have now put in place a project preparation facility. DBS has a similar one as well. What that does is effectively to mine data, analyze them, and tell you that if you invest this amount of money, you'll be able to get repaid over time. So that works. Bankability is very important. Without that, you can't attract private sector capital. Now, what the lady was talking about there, very important, because we know that Africa, there is an exaggerated sense of risk on the continent. So a lot of foreign direct investment, does not come into the country into the continent because of that exaggerated risk. So we, as an African development finance institution, have conceptualized two key products. One is what we call investment guarantee facility. We use that to attract inward investment into Africa. I would say to whoever is investing, just focus on the commercial risk. If there's any issue, political or otherwise, then you transfer that risk to us, and you just focus on the commercial. And we've used that to leverage a lot of inward investment onto the continent. The other one is either contract frustration or sovereign obligations guarantee. That is to say, if the government commits, because we know on the continent we are used to new governments changing policies and rubbishing what the previous ones did. So we say we will be there to make sure that whatever a government commits to you is provided to you, whether or not that government is empowered. So those are the two products that we've used to attract investment, which can be used for the rail sector. Thank you so much.
Okay. Bongo Pachala, you have the final word.
Just on the note of showing the money.
Show me the money.
Our clients we've been showing our clients our money. Not only that they've been seeing it, they've been touching it.
Yes.
So just to make a few examples of projects we financed on the continent, we've just wrapped up a financing arrangement of a big project in the DRC. We worked on that one with the ECIC. There was a signing off of the financing agreements. We worked on that one also with the South African bank, the Red Bank. So we're proud of ourselves because some people tend to say DRC is a very volatile market, right? But we as the DBSA, where there are opportunities to improve people's lives, we will go into those markets and finance as long as we are satisfied with the risk that we're taking. And we've been doing that throughout. I mean, also in Mozambique, there's another project, a terminal that we are financing there. As you know, there's that area is plagued with insurgency. There's all sorts of things happening there. And some commercial banks and DFIs would walk away from that market and say, we don't want to finance. But as the DBSA, that's where we go. And because we know that by financing those projects, we're going to change the people's lives. And that's what we're all about. Thank you.
That's amazing. I think that's a good point to leave it, ladies and gentlemen. Please give a round of applause to our esteemed panelists. We were joined by Nina Yosef from the IDC, Dirk Vandenberg from UK Trade, and we also had Bongo Pacela from the DBSA, Humphrey Nugo from Afrexim Bank, as well as Portia Dube from ECIC. Thank you.